What if we could, cut through all the noise and get a rare glimpse into the mind of one of the greatest investors and thinkers, really, of our time? We're talking about Warren Buffett, the Oracle of Omaha. And today, we're not just scratching the surface of his financial wisdom. We're taking a deep dive into two incredibly insightful collections, Buffett's Tips and Warren Buffett's Ground Rules. Our mission, to pull out the most important nuggets of knowledge, not just about money, actually, but about the character, the habits, the mindset, everything that made Buffett, well, a legend. Now, for those of you who follow finance, Buffett's principles might seem familiar, right? But today, we're aiming to go beyond the headlines. We want to distill the less obvious wisdom from his collected insights. The surprising nuances, the subtle mindset shifts, maybe the really practical takeaways that hit differently when you see them through his unique lens. So whether you're trying to figure out complex financial decisions or maybe just seeking some clarity in this, well, information overload we live in, this deep dive is definitely for you.
Get ready for, hopefully, a deeper understanding, not just a recap. Okay, let's unpack this. We hear so much about financial literacy, financial independence, but what does it actually mean day to day? Especially when, the sources point out that so many households would genuinely struggle, really struggle, to cover even a $400 emergency. It's quite a paradox.
It truly is. And a key insight from these texts is how they frame financial literacy. It's not just about knowing stuff, right? It's presented as a path to, well, profound confidence, freedom from stress. It's about empowering you, the listener, to make good financial decisions, maybe break free from that paycheck-to-paycheck cycle, and ultimately live the life you actually want, and maybe help people and causes you care about along the way. It connects directly to your mental well-being, not just your bank balance.
Right. A cornerstone of that journey, something Buffett famously called the eighth wonder of the world, is compound interest. Now, most people get the basic idea, I think. But what specific nuances or, profound implications do these sources really reveal that make its power just astonishing?
Well, the real power of compound interest, earning gains on gains, is that it's exponential. It's not linear at all. It accelerates incredibly fast over time, builds momentum like a snowball rolling downhill, getting bigger and faster. And the books highlight two critical factors: the annual average rate of gain, obviously, but maybe even more importantly, time, just sheer time. To put it in perspective, think about Queen Isabella back in 1492. If she'd invested $30,000 at just 4% annually instead of, funding Columbus, that money, it would have been worth an astonishing $2 trillion by 1963.
$2 trillion, wow.
And an incredible $7.3 trillion today. It's mind-boggling. That's money just multiplying itself over centuries. But this raises a really important question, doesn't it? If small differences in rates matter that much, what about those hidden costs, the things that chip away at those gains?
Exactly. That's a great point. The stories and the sources really show how fees and taxes can act as slippage. That's a good word for it. Like this silent traumatic drag on your long-term returns, eating away at your gains. You might not even realize it's happening. Consider that amusing but kind of sobering tale about the Manhattan Indians. If their $24 investment back in 1626 had compounded at, say, 6.12% annually, okay, it'd be $42 billion by 1965. Yeah. Still amazing. But bump that rate up just an extra half a point, tiny, right? 7%. Suddenly it's $25 billion more, $67 billion total. That tiny difference in rate over centuries is just monumental.
It really underscores the point. Understanding compounding means truly internalizing that every percentage point, every seemingly small fee, every year you wait to start, it all has this monumental, almost, terrifying impact on your future wealth. It's this quiet force, working relentlessly, either for you or, if you neglect it, working against you.
Okay, so we've seen the incredible, almost magical power of time and compounding. But that money, it has to be put to work wisely for it to grow like that. So let's pivot a bit. Let's move from the mechanics of money growth to the maybe art of how Buffett actually picks investments. What's really at the core of his legendary and often kind of counterintuitive approach?
Well, at its heart, Buffett's approach is rooted in value investing. Basically, buying businesses at a discount to what he figures is their real intrinsic value. Think of it like getting a quality item that's been marked down. But the real insight here, I think, isn't just spotting a cheap price tag. It's the profound discipline involved. First, figuring out that true intrinsic value, especially when the market is, let's be honest, often irrational. And then having the patience, the sheer conviction to wait for that value to be recognized, often for years.
Patience is key.
Absolutely. He famously bought Berkshire Hathaway stock, his own company now, for $7.65 a share when his analysis showed it was worth at least $20. Another classic example, American Express. He bought heavily when its stock just cratered after a scandal back in 1963. He believed its core businesses, credit cards, travelers' checks, were fundamentally sound, even though the market was panicking and everyone else was running away.
Right. And he talks constantly about finding businesses with moats. We all get the image of a castle moat, but what exactly does he mean by that in a business context? What's the deeper insight there for investors?
Yeah, the moat is that sustainable competitive advantage, like the water around the castle, protecting the business from rivals. But the real insight, I think, isn't just identifying a moat, it's understanding its durability. How long will it last? And its widening potential. Is it getting stronger or weaker over time?
So it's dynamic.
Exactly. Buffett is constantly asking that because even the best competitive advantage can erode. It could stem from, delighting customers, really strong branding, maybe in a super efficient distribution network, or sometimes just superior management. It's interesting. The authors note that Berkshire Hathaway's corporate headquarters for this massive company has only about 25 people.
25.
Yeah.
For nearly 400,000 employees.
Yeah. It's a real testament to his strategy. Buy good businesses with good decentralized management, and then largely leave them alone. Let their moats thrive without micromanagement from Omaha.
Okay, so given this focus on fundamental value, long-term value, it's interesting how he views something as common as stock splits. I mean, a lot of investors actually like them. They think it makes a stock more accessible or something. So what's his unconventional take? Why does he see them as mostly a distraction? What's the downside?
He fundamentally sees them as basically an accounting trick. That's his term. It doesn't change the company's underlying value one bit. Zero. He argues that people who buy for what he calls non-value reasons, like maybe the lower share price seems cheaper or just because it's in the headlines, well, those people are far more likely to sell for non-value reasons too, which just increases price volatility, makes things jumpy.
Yeah, attracts the wrong kind of shareholder for his long-term view.
Precisely. He famously created Berkshire's Class B shares specifically to give smaller investors access without having to split the very expensive Class A stock. He wanted to maintain the integrity of his long-term, value-oriented shareholder base.
So, investing like Buffett, it really means looking way beyond the superficial numbers, beyond the short-term market chatter and psychology. It means diving deep into the actual business, assessing its long-term competitive strengths, those moats, and trusting in sound management. Even when the market is going crazy, either panicking or being irrationally exuberant, it demands a level of critical thinking and, frankly, emotional control that many people find really challenging. But Buffett's wisdom, as the sources really make clear, isn't just about balance sheets and stock prices, is it? He shared these invaluable life lessons with college students, often suggesting that these non-financial insights were just as critical, maybe even more critical, to living a truly rich life. What stands out to you from his, let's call it, non-financial advice?
It is striking, isn't it? His consistent emphasis on qualities like communication skills, having inspiring friends, helping others. These things underpin his entire philosophy, it seems. He didn't just think communication skills were valuable. He believed they were the most valuable asset for a successful career, capable of fundamentally changing your whole trajectory.
Yeah, and he didn't just say it, he lived it. He credited that Dale Carnegie course with literally changing his life for the better. So much so, he still hangs that diploma on his office wall, apparently, instead of his fancy college degrees. He had that fantastic line, you remember, having a good idea and not being able to communicate it is similar to liking a girl and winking at her in the dark. Nobody sees it. He actually estimated that strong communication could increase your lifetime earnings by 50%. 50. That's an incredible return on what some people call a soft skill, showing its real-world impact.
Which, raises an important question. How do you actually develop that kind of conviction? How do you stay true to your own path when all these external pressures are so strong? Buffett talked a lot about the inner scorecard, which means basically living your life on your own terms, guided by your own self-judgment, your own values, rather than being swayed by an outer scorecard, what other people think, what society expects.
The keeping up with the Joneses idea.
Exactly, and he'd often pose this provocative question to illustrate it. Would you rather be the world's greatest lover, but have everyone think you're the worst? Or be the world's worst lover, but have everyone think you're the greatest? It forces you to choose, doesn't it? Between internal satisfaction and external validation. It really reveals where your true priorities lie.
That's powerful stuff. And he backed it up with actions. Like you said, integrity was huge for him. Famously, proactively shutting down his partnership in the late 1960s because he felt the market was just too expensive, too frothy. Instead of risking his investors' money just to chase more gains for his own, personal gain or glory, that takes discipline. And of course, his massive commitment to philanthropy, giving away over 99% of his wealth, it really shows his dedication was more to the love of the game, building and understanding businesses rather than just piling up money for its own sake.
Precisely. Buffett's lessons, taken together, show that true success really encompasses not just financial achievement, but also personal integrity, effective communication, and crucially, the freedom to live authentically according to your own values. Cultivating that inner scorecard, it's quite a holistic view, almost philosophical, of what makes a rich life.
Okay, let's shift gears maybe one last time to something really practical, down to earth. Buffett himself is famous for being incredibly thrifty, isn't he? Even driving a modest car, famously with thrifty on the license plate. It seems almost counterintuitive for a billionaire. How does he actually define thriftiness, and why is saving, specifically, so profoundly important in his view?
Yeah, it's interesting. He clarifies that being thrifty isn't about being cheap or stingy. It's about being careful, smart, and not wasteful with money. It's about intentionality, aligning your spending with your values. And he points at something simple but powerful. Saving money, unlike earning it, goes directly to your net worth. Why? Because you don't pay taxes on money you save.
Good point.
But maybe more than that, saving gives you control. It gives you flexibility, a buffer against life's inevitable curveballs. The books highlight tons of ways to save, from, diligent comparison shopping, using coupons. Can you imagine Buffett and Bill Gates actually using coupons at McDonald's for breakfast? Apparently it happened.
Really?
Yeah, it just drives home that it's about smart choices, not deprivation, regardless of your net worth. It could be buying in bulk or wisely looking for quality used items instead of always buying new.
So it's less about deprivation, more about conscious consumption, prioritization. It reminds me of that story about him using a flip phone for years, long after smartphones were common. It's about avoiding unnecessary spending on stuff that doesn't add real, enduring value to his life. It's a powerful lesson in intentionality, isn't it? Even for a billionaire. Okay, let's unpack this with two of the biggest purchases most people make: cars and homes. What's the Buffett-esque advice there, considering their huge impact on personal finances?
Right, the big ones. With cars, financially speaking, a used car is almost always a better deal. Why? Because of that rapid depreciation of new cars. Often losing, 20% of its value the moment you drive it off the lot? It's a huge immediate loss. The books even suggest buying a 10-year-old car, holding it for 5 years, then just repeating that cycle. That's often the cheapest strategy over the long term. Avoids that massive initial hit. It's about understanding the asset's true function and cost, not just its new car smell.
Okay, that makes sense from a pure numbers perspective. And what about homes? Often seen as the ultimate American dream, right?
Yeah.
But also a massive investment, massive debt usually.
Indeed. With homes, Buffett actually calls it one of the best investments you'll likely ever make, especially if you plan to stay in an area for at least a few years.
Why is that?
Well, you're building equity over time, and you avoid the constant transaction costs of moving frequently. Plus, he views affordable mortgage debt, specifically fixed-rate mortgages, as a kind of one-way bet. Because you have the flexibility, the option to refinance if interest rates fall significantly. But if rates rise, you're locked into that favorable lower rate. That optionality is key. It makes the mortgage potentially a strategic asset, not just a liability hanging over you.
So adopting that thrifty mindset, embracing conscious consumption, making informed strategic decisions on big-ticket items like cars and homes, it all adds up. You can significantly boost your long-term financial security, build wealth over time. It's really about being strategic with your spending, not just focusing solely on your investing.
Wow. Okay, this deep dive has really revealed the sheer breadth of Warren Buffett's philosophy, hasn't it? It extends so far beyond just stock tips. It's more like a holistic blueprint for a rich life, in the broadest sense. It's a testament to how financial savvy, personal integrity, and self-awareness are all deeply interconnected in his worldview. His teachings, they aren't just for billionaires, are there? They feel like a roadmap for anyone seeking greater independence, maybe a more fulfilling existence. But applying them consistently, that's the tricky part, isn't it? Not easy at all. But his wisdom consistently links that financial success with a life genuinely well-lived, always emphasizing integrity, self-reliance, and a deep understanding of what truly matters beyond just accumulating money. He kind of proves that the love of the game, the process, the understanding can lead to immense wealth, both financial and personal, especially when it's guided by clear, unwavering principles.
So as you, our listener, reflect on Buffett's consistent emphasis on cultivating that inner scorecard. Maybe consider this. In a world that's constantly pushing us towards external validation, towards quick wins, towards comparing ourselves, what does your inner scorecard actually look like? And maybe more importantly, how is it truly guiding your decisions? Today and for the long term. Something to think about.